All right, hello and welcome everyone. Doug here with thelincolnlist.com. Today we're going to talk about the best indicators to use in trading. And we're going to focus on the 10, the 20, the 50, and the 200 simple moving average. I'm going to show you what these are for, why they work, and then give you a couple of different trade setups so you can use these immediately in your trading business. Now, if you remember, I did a video a couple of weeks ago. It was about the VWAP, and I'll post that link around here somewhere for those that want to learn about the VWAP. If it's not on the screen, it'll be down in the description box. But what I want to build off of for those who saw it is that I mentioned that with technical analysis, there's no such thing as a holy grail. I kind of want to set that tone early because there's no perfection when it comes to market, because until they can create an indicator that can judge every single human being's emotion, you're never going to have perfection. There's just too much emotion in the market. But our job as day traders specifically is all about timing and getting the best entries and maximizing our exits. So if you think about it, there are three components to a trade: idea, execution, and management. Most of us have the right idea. Like, we can look at a chart and we can tell within a short period of time, this stock's going to go up, this stock's going to go down. However, the difficult part that separates the pros from the Joes is, when do I buy the damn thing and when do I sell it? You know, if the market's pulling back and you start to get a little worried about a position you have, when do I sell it? And this is what we use things like VWAP, moving averages, and so on. So let's kind of go into it and get right down to it and start talking about what they are. Now, I use just simple moving averages. I use the 10, 20, 50, and the 200. But what they are is a measurement of the average price over that period of time. So if you look at this upper chart that I have here on the screen, this is an intraday 5-minute chart. So this yellow line right here, where I'm kind of pointing to, that is the intraday 10 moving average, simple moving average. So what does that mean? That means that that is the average price of the last 10 bars on that 5-minute chart. So I hope I didn't confuse anybody, but that is the last 10 bars average price on that 5-minute chart. So it's based on the time frame that you're looking at. Now, if you look at down below, I'll just highlight here up towards the top. I don't know if you can see that yellow line. That's on the daily chart. So that means that's the average price over the last 10 days of time. So this, instead of, if you're looking at a 5-minute chart, that's the last 10 bars over the last 5 minutes. And that's the average price of the last 10 over the daily chart. That's what a simple moving average is. It's just to calculate a moving average over a period of time. Now, what these things are used for us is to discover price and discover entry. Now, I'm not sure, like I said, with VWAP, what's the magic about it. You know, there's algos here, there's hedge funds here, but so many traders use these that you can find great ideas and great levels. So what I want to focus on first and foremost is the red line on either chart. You can look at the upper chart or the bottom chart. This is the 50 moving average. And the reason I want to focus on the 50 moving average is because folklore have it be, if that's what you want to call it. I don't know if it's written in some sort of technical manual book, but the 50 moving average sort of separates good from evil. So really, in just a quick look, if a stock is trading above its 50 moving average, then it's a bullish chart. It's still a bullish stock. If it's below its 50 moving average, it's considered to be a bearish stock. Now, some technical analysis people, depending on their strategy, may argue with that. But if you look around, you'll see the importance of how that 50 moving average works. Now, that could be intraday, and that could be on a daily chart. So if you look at the market here that I have, you look at the 50-day on the 5-minute chart, if it crosses below the 50 moving average intraday, that just means that chart is bearish for that time period. That's intraday. Obviously, the daily chart's 50 moving average would be more important because in a case like today where you saw the market bounce, the market had a huge bounce. It stayed above its 50 moving average intraday. It was very, very bullish, but the overall prospectus of the market right now is bearish because it's under its moving average. So one of the ways that you can use this is to discover bias in your trade. So for example, if you were trading the market today, you could understand that you are buying breakouts in stocks or you're trading on the bullish side, but overall the market is bearish. Now that has an impact on the way a trader makes decisions and the size they use versus trading a bullish chart in a bullish market, or trading a bearish chart in a bearish market, or trading a bearish chart, shorting a stock in a bullish market. Hope that kind of makes sense. So the 50 moving average has always been that line in the sand separating good from evil. Now the 200 moving average like we've said before in our support and resistance videos, and any calculus that you use for any kind of time frame, the longer that you have to go back into time, the longer it goes back, support, resistance, VWAPs, whatever you're looking at, price, the further you go back in time, the more important it is. So one of the things I want to focus here on is the market right now in its current state. If you see some of the videos that we did, the market mutterings and all that good stuff, we talked about after the market had broken down, we'll go back here to the bottom chart. I want you to look right over here in January. Once the market came down into its 10 moving average and it broke the 10 moving average, the nearest spot for it to trade back to would be the 20 moving average. Now, anytime a stock is at its 10 and 20 moving average, or the market itself, that's still a very relative bullish signal. And most of the times we've seen this market over the last couple of years bounce. But as we said, the deeper that you have to go, the more important that the indicator is. So once you kind of lose this 20 moving average on the 5th of, the 5th of February here, and it starts to dive, there's always that lot of people that are looking for, okay, where's the bottom? Where's the bottom? If you're looking at your positions and they're in the red, you're thinking about capitulating on certain stocks or certain investments that you have, or you just want to know when you can bounce this bad boy and make some money, you got to look at these levels. We look at support and resistance. We look at VWAP. We look down at these 50 moving averages and see if they coincide with anything. So once you really got that close under the 20 moving average, the next no-brainer spot this thing would travel to would be where? It would be down to that 50 moving average. So if you go back and you look at time in this chart down at the bottom, for the longest time, for several months from November that I'm showing just on this chart, the market never got underneath of the 20. So now you're talking about the market finally closes underneath the 20 moving average for the first time in several months. That's a big deal, right? That's a long period of time it stayed above that, long period of time it's been bullish, and then it finally breaks that. Now you can see it comes right down into the 50 and does nothing here to hold, and then just goes straight from the 50 to the 200. So this is a very, very big level. So it just skips right from the 50 straight down to the 200. And if you look down there at the bottom, we've talked about this in the market mutterings, our weekly recaps, our trade room and everything, is that the market makes a bounce on that 200 moving average. So when you're looking down there and you see that pin bar, wick, whatever you want to call it, on February 9th, and you see that bounce is really, really important because that's the 200-day moving average. That's a very important indicator for traders, institutions, and the like. So therefore, you're going to see that stuff bounce. And then, of course, where you see it bounce to eventually in the next few days is it comes back up to the 50 moving average. Now, losing that 50 moving average initially was a big deal because when you go back, let me see how far I can actually just take this chart right here. You go back in this chart for some time, you can see that it was like, it felt like years since this thing, the market itself, had been under the 50 moving average. So you're seeing a very big event happen. So what I'm trying to translate here when you're looking at technical analysis, number one is time. The further that you have to go back into time, the further that you have price discovery in time, the more important and impactful thing. So at February 9th, when that market got down to the 200, I can't remember off the top of my head. It might have been since 2012 or 2014. Don't quote me on that, but I know it's been years. Not only has it not been to the 50, but gotten down into the 200 moving average. So think about that event right there. You've been in the linear market for several years, and when it finally starts breaking down, you need to find these types of levels and find out, is it going to hold these? Because this is what the traders are looking at. Now, the first go around, it does hold that. Market bounces back up into the 50 moving average. We discussed that for months. You can see how it bounced up, bounced down, goes up and through. And then finally, again, it loses that. And you are where you are today, trading back down into the 200-day moving average. So think about what you're just looking at here, just one simple line, one simple calculation. That's why it's called a simple moving average. It doesn't have to be fancy. But look what this market did. It sold down into the 50. It went from the 50 down to the 200. It went from the 200, bounced back up to the 50, hung out at the 50 for about a month or so, and traded back down into the 200. Right there it is on the chart. There's no secrets in this. It's just looking for price discovery. So if you're making a trade and you're saying to yourself, let's give you a couple of different variations. Let's say you're making a trade. You're buying a breakout and you're looking at what would be my stop. Let's pull up a stock for the intraday. How about let me use NVIDIA. We'll use NVIDIA. Okay. We'll go through some scenarios. All right. So I'm going to back this up. This is the opening right here. Okay. Up here, the 5-minute chart. Let's say you're a day trader. You're just looking to pick up some money. You're not really concerned about the daily chart because NVIDIA is away from its 200 moving average there on the daily chart. But when the market rises, the rising tide lifts all boats. So let's say you're thinking, man, I want to buy a breakout. If we go over high a day here, let's say $218.52. I hope I'm not losing anyone. Then I want to buy me some NVIDIA. I want to get long some NVIDIA. Stock's going up, it's breaking out, and so on. So the first thing you want to assess is the risk. So once this thing starts to break out, okay, the thing you want to look at is let's just take a look at the 50 moving average, which is 217.47. So once this thing makes a breakout, you have a legit buy here at 219 with the stop, let's say at 217, just slightly under the 50 moving average. Now, when I say nothing is perfect, what I mean by that is what we tend to do as traders is use that as a mental area. I mean, that doesn't mean I'm just going to park a stop loss right there on it. In this case, I'd probably go right underneath the support right there at like 215.5, see what the action was on the 50. But see, that's what's important. Let's say this thing trailed down into the 50 moving average there, right? And you were wondering, did I make a mistake? When he gets to the 50 moving average, what does it tell you? You pay really close attention to that stock. Look at the volume that comes in. Look at the buyers, look at the sellers, look at the action. You'll often see volumes start to perk up when they get close to these moving average. That will tell you, the trader, what the interest is. So if it fades down there and all of a sudden I see, bam, a lot of volume coming in there, it spikes off that 50 moving average real hard, then that's telling me that 50 moving average means business. That's important. I saw the volume, I saw the action, I saw the bounce. I'm confident. I'm confident that this thing is going to go. Now you see what NVIDIA does is it kind of rolls up. It's staying real tight. Now when I mentioned further back in time, the more important. Now, the shorter in time, the more bullish. So this little yellow line right here is the 10 moving average. I don't like to use these a lot because they're kind of sketchy. It's like trading on a 1-minute chart for me. But, you know, anytime something stays above its 10 moving average or a short-term moving, I know some traders use an 8 moving average. That's really freaking bullish. I mean, that is super damn bullish if a stock can hold a certain period of time, half hour, hour, above that. That is a seriously bullish chart that's under a lot of momentum. But later on, what I want you to focus is it kind of levels off. So the stock comes up, levels off. Now it's in a period of consolidation, a period of digestion. Then it finally loses both the 10 and the 20. That's the yellow and the green. Does that right here about 9:55 in the morning. That's Pacific Coast time. Maybe like 1 o'clock there on the East Coast. And then it starts to drift. So as this is drifting, people are probably wondering, I should say noobs, as it's drifting down there like this right here, and you start to think, what if you were long at 222? Like, did I make a mistake? Where would this thing go? See, that's what we want to know. Where will it go? So I'm either in it and it's drifting. Should I cut? Should I take the loss? Or should I hold on? Should I hold on where it might stop? Should I add? If I want to initiate a position, where am I looking at the chart to initiate? I would be looking down there at 220. Where? At the 50 moving average. It's sitting right there. And look what this thing does. It trails right into it. And again, it's not perfect. It slid under the 50 moving average just a little bit, but look where it started to catch a bid. Look where people started to come in. They came in at that intraday 50 moving average. And then, of course, from there it goes. It starts trailing back up the 10, and that's where it finished the rest of the day. And now here after hours, the 50 moving average is catching up with it. So let's take a review and see what we're talking about with moving averages just like the VWAP. This is a price discovery tool. So if you have bought a stock, for example, let's say you are already in a position and the position is squeezing you somewhat, and you start to get a fade like this NVIDIA right here, and you're wondering, where should I cut my losses? Where should I add to this position if I want to? Where may I see some reinforcement? Where will the cavalry come in to save me? The 50 moving average. Once it's underneath the 20, you look at the next support, 50 moving average, and possibly VWAP. Now once it bounces, you look at those moving averages as the next line of resistance. So if you did buy this at the 50 moving average, you could use those 10 and the 20 moving average, which was sitting right here at one point at 221.39. You can use that as your short-term target. So when you buy it down here at 219, your first initial target is 221. That's your target. So if you're selling anywhere from the time you enter that before 221, in most cases, you're cutting yourself short. Because if you believe that theory that stocks trade from one level to the next, then it should trade from that level right there, the 50, and at least make an attempt. It may not get to the 20 to the penny, but it should at least get you to 221. Now, is that going to work out in every scenario? No, it's not. Sometimes you'll buy that and it'll just dump right on down there to 216, down to the next support. That happens. You know, that comes with experience and reading the tape a little bit or getting an understanding of that. But it's a great benchmark for traders to start with. You look for one average to the next, because what we're trying to do is, if we buy this, we don't want to buy this stock. If you waited here, because here's what's a problem for a lot of traders, and hey, I'm guilty of this too. You buy this thing at 220, and then it pops on one green bar and you sell it at 220 and a half for 50 cents. Or you sell it for $1 and you start chest pounding. I'm a winning trader, right? And then the damn thing goes up to 226 at the end of the day, and like, I'm a losing trader now. So that's why we use them, because we want to maximize the target as well. We're in it to make money. And when you think about pros and Joes, that's what it is. It's not the winning ratio. It's that they make more money. Their winners are bigger than what their losers are. So let's do like a quick review here, and let's just look at it. Remember, in any technical analysis, whether you're using support and resistance, VWAP, or any one of these moving averages, the further you go back in time, the more important that indicator is. So when you're looking at that 50 moving average on the daily chart that we showed with the SPY in the market, when you finally lose that after a year or two and you close below that, that is a very big deal. That's not just like losing the 50 moving average on it. If the market was up like it was in January, December, and the market just trailed underneath of the 50 moving average on the intraday chart, the 5-minute chart, yeah, it's just bearish intraday, for that time period. It's not really bearish. I mean, it's bearish for that time, but it's not overall bearish because the market's bullish, right? Hope you understand that. In this case, the market's bearish, and now the stocks that go under the 50 moving average are also bearish, so things could have higher implications. So the further you go back in time, the more important that it is. When we look for our entries, that's what we want to do. So when you see a stock pulling back and you say, where do I want to enter because I want to buy this thing, look for that support and resistance that goes further back in time. Look for the 50 moving average as a pivot point for the stock. See if it builds around those areas. If nothing else, you look at these levels and you get an idea for the market. You'll see how the volume, if you watch it in real time, you'll see how the volume, you see how the action, and you'll get a gauge for the sentiment that's in this stock. And that'll give you the confidence that you need to make the trade. As always, these things are not perfection. The 200 moving average itself hasn't really come into play whatsoever in stocks, I think, in years. Now that we're down here in the market, it's a very important thing going forward. So when you're just looking at moving averages, again, you'll have to apply these moving averages along with things like support and resistance, like VWAP. No one will stand. But if you look at the market today, it bounced off the 200 moving average. We're down here in the bottom screen. Off the blue line, went to the 10 moving average, right? And that's where it stopped. No secret that it stopped there. So if we go higher and you say, where's our next higher? You have some resistance. We're using support and resistance now. You got resistance right here from the 27th of March, which is, I don't know, say 266. And then you see the 20 moving average just kind of dangling up there in space at about 268. So if you buy it and you're looking to swing it because you think the market's going up, that's your targets, 266 to 268, above that resistance from a few days ago, and then the 20 moving average. That's how you can gauge your targets and maximize your wins. Because again, if stocks trade from one level to the next level, that's your ordeal, then that's what happens. That's your thing. So anyway, I kind of hope this lesson made a little bit of sense to you. As always, if you need some help trading, I'll post the link somewhere or look down in the description box. Visit thelincolnlist.com. Trade with us live each day. If you have any questions about any of the indicators, the VWAP, feel free to send them to me, support@thelincolnlist.com. Until the next lesson, take care. Thanks for watching.